In the US, we have lots of different types of savings and investment accounts. So what happens to these accounts when you all of a sudden decide you want to live outside the US? What does that mean for you as an American living abroad? So let's look at different account types. First of all, individual and joint accounts. The big consideration there might be is that you might have what's called transfer on death designation on these accounts, which is like a beneficiary designation. But this comes under US state law. And so once you no longer have a US address, you're going to lose that TOD designation. And so if it's an individual account and you're concerned about what happens to you, what happens to the money if something happens to you, then maybe you might want to add a joint account holder, or maybe you might want to have a power of attorney on that account to replace that TOD designation. What about traditional IRAs? A lot of people have 401k plans in the US that they roll over into IRAs, or maybe they've been contributing to an IRA over the years. So can expats still contribute to an IRA while living abroad? Well, it depends on whether you have US source income. You need to have US source income in order to be able to contribute to an IRA account. And if you're excluding that income under what's called the Foreign Earned Income Exclusion, for example, then you may not be eligible to contribute to IRA accounts. What about 401ks? Well, it's a similar type of thing. So first of all, to contribute to a 401k, you again have to have US source income. You have to be generally working for a US employer that offers the 401k plan, and hopefully they're going to do matching into that plan. So 401k plans are a lot like IRA accounts. And then what about the distributions? How are IRA and 401k distributions taxed when living abroad? Well, generally speaking, if there's a tax treaty, they're going to be taxable to you in your country of residency. That's the way most tax treaties read. And then what happens to old 401ks when you move abroad? Can you keep them? Should you roll them over? Well, 401ks, you might be able to keep them, but you really need to look at who's holding that 401k. Is it a company like Fidelity? Will they allow you to keep that 401k account when you no longer have a US residence? So that's the primary consideration there. And also, if not, you might want to roll it over into an IRA account, and then that IRA account could be moved to another institution that's expat friendly. What about Roth IRAs? Roth IRAs can be problematic because they are not mentioned under most tax treaties. And so they can be considered as not tax-free. In other words, as taxable accounts in your local country, in your country of residency. And obviously, that's very different from the US tax treatment where Roth IRA accounts are considered tax-free. And so that brings up the situation where many US advisors might give you the advice to do an IRA conversion, roll over your IRA account to a Roth account, pay the taxes, because now you're maybe retired, you're in a low tax bracket, so you want to pay those taxes, you want to convert to a Roth account, and then you're never taxed on that money again. But if that Roth account is taxable in your country of residency, that's really bad advice, because you're going to pay that tax twice, or at least some of it. What about trust accounts? So the issue with trust accounts is that, first of all, a US trust may not be recognized under local laws. And even if it is recognized, it could be taxed at a higher rate. We're used to revocable or grantor trusts in the US that use our social security numbers, and so the tax effects just flow to you individually. But that may not be the case in your country of residency, and there may be a punitive rate of taxation applied to a trust. This is, for example, the case in France. Also in France, they have hereditary laws, and they do in other places as well. And this may be an estate planning concern for you. Now, in some places, you may be able to elect to be taxed under US laws rather than local laws, but you have to make that election. So that's one way sometimes to avoid those things. What about HSA accounts, health savings accounts? Can they still be useful? Well, they could be useful. You can still use them for things like prescriptions, for example, when you're overseas. But you may have access to national health. If you don't have national health, you may have private health insurance in that other country. So you may not even get that much mileage out of these HSA accounts. But you can still use them for incidentals and to augment maybe health care that you don't get under these other plans. And then these accounts can be invested as well, and generally the investments are tax deferred. But they may not be taxed, but again, it may not be tax deferred for local taxation. This is like a US thing. HSA accounts aren't mentioned in tax treaties, just like Roth accounts often aren't. But they can be managed through a brokerage window, for example, with Charles Schwab or something, and you can have investments in there. And then generally you can withdraw from those accounts without penalty once you reach age 65, but you'll need to pay tax if it's not a qualified medical expense. What about 529 plans? Maybe you're saving for college for your kids in a 529 plan. Well, these 529 plans can still be used at some institutions outside the US. They have to be what are called qualified institutions. And generally, it's a qualified institution if it has access to a US loan program, FAFSA loans. And there's a whole list of qualified institutions that you can use for these 529 plans. If you can't use it, they can be rolled over to others, to siblings, even to children of children, your grandchildren maybe, they can be rolled over to them. And now there's a new law where up to $35,000 of those 529 plans can be converted to a Roth account for the beneficiary. Although there are limits and a bunch of hurdles you have to jump through, but generally that's also possible. And then ultimately, if none of that applies to you, well, you can still take the money out and pay the penalty and tax on the earnings, but it's been tax deferred earnings in the meantime, so at least that has offset maybe the penalty if it's been invested for a longer period of time. What about things like annuities? Well, annuities are problematic because generally there's a broker of record on the annuity who has sold you this annuity. And if that broker of record can't deal with you as an expat anymore, well, then you've got a little bit of a problem. And what you need to do in that case is to take the broker off of the annuity, and the annuity becomes a house account with the firm that actually issued the annuity. So then you're dealing directly with that firm instead of through the broker. Also, distributions from annuities may need to go to a US bank. It's unlikely that an American annuity will send the money to your foreign bank account, but you could probably have them sent to something like a WISE account and then convert to another currency and then send it overseas. There are also tax considerations for things like muni bonds and capital gains. So municipal bonds generally pay a lower rate of interest because they are tax exempt. But this may not be useful to you as an expat because they're not going to be tax exempt. The interest isn't going to be tax exempt locally for you. So you're going to end up paying tax on that interest anyway. And now you've got a lower rate of interest. So you're probably better off investing in taxable bonds as a US expat. Also, generally speaking, in other countries, we don't have the same long-term capital gains rates. In the US, you hold an investment for longer than a year, you get taxed at a lower rate on it. But in other countries, that capital gain may be taxed to you even as income, as your income tax rates, or maybe there are other provisions that apply to capital gains, but you don't get this tax break. And then there's different rates of taxation, sometimes depending on your income. For example, in Spain, the rate of taxation on savings, things like brokerage accounts and bank accounts, is much lower than the rate of taxation on other income. Other income would include things like money coming out of US retirement accounts. And then there's non-US accounts such as ISAs, for example, in the UK, which may not be considered tax-free in the USA. Or there are also various types of products, usually insurance products, that are sold as tax wrappers, what are called tax wrappers. That is to say, you have an account, but then it's wrapped in this insurance product typically, and that eliminates some taxation for you or makes it tax deferred. Be very careful about these. It may not be tax deferred for US tax purposes. The investments within that may be considered PFICs and taxable at different rates in the US and cause you US tax reporting headaches.